So we're live. Good evening, everyone.
Good evening,
Good
everyone.
evening.
So we are back. So as we say that we have also got the habit of remaining connected with you all. So today's subject is also very new, and uh, it has been a very big issue for all the persons who are getting evaluation done, and including the insolvency professionals like maybe RP or liquidator. Mm, But this is again something which is making the insolvency profession a more difficult profession than others. You see, like everybody can give disclaimers, but the insolvency professional cannot give any disclaimer. Valuers can give disclaimer. The uh, the forensic auditors or transactional auditors can also give disclaimer. And every disclaimer is that the RP has not provided information or the liquidator has not provided information. So this is an important subject. Uh, the IBBI has provided guidelines to us, and when we actually go through the guidelines carefully, word by word, so it is not much of a relief to the insolvency professionals or the users of the report. Rather, it is making it more official. Yes, this kind of limitations, this kind of disclaimers, or this kind of caveats can be given by the valuers. This actually makes it clear, and the duty has been now casted on the person who is getting the valuation done. More so in our profession, insolvency professionals may be acting as a liquidator or as a resolution professional. So they would be now under more responsibility, obligation to provide information to the valuers. The similar situation lies with the transactional auditors and the forensic auditors. They also provide too many disclaimers and limitations. They also provide at times disclaimer that they have not verified the information provided by the RP or provided by the any KMP of the corporate data. So in one of the cases, like I have heard in my own presence, the NCLT benches are saying, the members are saying that with these disclaimers, how can we use this report? It is just a wastage of time of court. It is a wastage of time of the RP and the lawyers. But now the situation is the IBBI has made it very clear that the disclaimers or caveats or the or the
Limitation.
limitations uh, has to be given uh, to justify a scenario of limitation of information available to valuer. So this should be used uh, only in case there was limitations in performance, there was limitations in carrying out the job. Only those limitations should be mentioned in the caveats and disclaimers and limitations. However, the objective should not be to shy away from the responsibilities, liability of a professional valuer. The objective only should be to highlight the limitations while they were doing the job, while they were doing their part. So I think with this, I hand over the uh, webinar to Ankit with his introduction, as he's very regular, but then I must introduce because there are many new participants. Today's subject is a new subject. Ankit is a chartered accountant. He's handling a chartered accountancy practice by the name of Triple AG and Company. This is a mid-level chartered accountancy firm and doing a lot of good work. Ankit is also handling a valuation entity, which is AAA Valuation Professionals LLP. He is the founder partner. Mr. Rakesh Mehta is a qualified engineer. He's a valuer of plant and machinery. He's a full-time partner and chief executive officer of AAA Valuation Professionals LLP, with a valuation entity recognized by IBBI. See, both these experienced valuers, and Ankit is also a partner in AAA Insolvency Professionals LLP. He have seen all other partners struggling how to handle the valuation assignments, how to handle the disclaimers, how to handle the limitations which are given by the valuers. So he would have the experience of all the three. So I hand over to you, Ankit. Where do I only have one observation that this the all this CLD, as we called caveat and limitations and disclaimers. In short, we call it CLDs. All these CLDs actually should be explained in short, and the more focus should be how to collect information, and if one information is not available, what alternative information can be used, how the valuers can also make some estimates, how the valuers can also use their experience, and they also should be proactive in completing the assignments rather than going by the words of these guidelines. Over to Ankit and Rakesh Mehta ji.
Thank you. Thank you so much. Good evening, everyone, and pleasure to be here again. And looking forward to this webinar. This subject is something that has been in discussion in valuation forums for quite a long time, and it is also something that has been a troublemaker for insolvency professionals in the past. Today's webinar, we will be focusing on going through the guidelines issued by IVBI. We will be understanding its structure majorly, how it has been worded, what are the duties of the evaluation professionals that the circular has listed down, what are the disclaimers it has expressly said or stated that those disclaimers cannot be put into the report. It is a very important part of the report, although it's a very brief part, but it is a very important part that these disclaimers, they have disallowed those disclaimers and said that you can't put in these disclaimers. Then they have also come out with a lot of examples of various caveats, disclaimers, and limitations. And IBBI has basically taken the expert committee's opinion, clubbed it with the various opinion given by the RVOs, and come out with a long list of possible caveats, disclaimers, limitations which can be used by valuers in their valuation report. My personal view is that these CLDs that they have suggested are, of course, examples, and those examples may not fit in all circumstances. And that's what we will discuss. We will talk about what circumstances will require such disclaimers or caveats, and which disclaimers are not that cannot be avoided, or which ones are very normal in the industry and they don't have a significant, I would say, impact on the veracity of the evaluation report. So I'll just share my screen. Just give me a second. So we are here, and this is the subject of the. This is basically the our agenda for today. We'll be talking about understanding the guidelines. We will be talking about what is the difference between caveats, limitations, and disclaimers. We're talking about general requirements from a valuation report. This is also part of these guidelines. Then we will talk about CLDs not permitted, commonly allowed CLDs for various asset classes. Then we will also talk about the role of resolution professionals, and we will be doing that almost throughout the presentation, but also we will be focusing on that at that end where we have a few pages on our slides with respect to this role. We will be talking about the importance of limiting CLDs. How does that affect the whole process of CIRP or the bankers in case of other reports? Then importance of limiting CLDs in transaction audit report, because that is also something that is connected to caveats, limitations, and disclaimers, even if it is not in the valuation report. Even when you talk about the transaction audit report, it is a very important subject. Quick facts. So these guidelines are called the Insolvency and Bankruptcy Board of India Use of Caveats, Limitations, and Disclaimers in Valuation Reports Guidelines 2020. They will come into effect from 1st October 2020, and they have made it very, very clear that it shall come into force with respect to valuation reports, where the valuations are being completed by registered valuers on or after this date. So even if somebody perhaps has issued a draft valuation report before 1st October and the final valuation report is being issued after 1st October, in my opinion, those valuation reports will have to adhere with these guidelines. And this is something which is important for our values to understand, and also for insolvency professionals to keep a check on, so that because a valuation report and an insolvency professional's requirement for the valuation report, or for the matter of fact any other consumer of valuation report, it is important that the valuation report is based on the up to date laws. Rule 8 of the company's registered valuers and valuation rules 2017, they mandate that the valuers shall state caveats, limitations, and disclaimers to the extent they explain or elucidate the limitations faced by the valuer, which shall not be for the purpose of limiting his responsibility for the valuation report or make the valuation unsuitable for the purpose for which the valuation was conducted. Now, let's wait here, read this rule, and go through this maybe a little word by word meaning, or derive the meaning from this, because this is a very important part of the diktat, or I would say the law that valuers are required to follow. Valuers registered with IBBI and which are registered under the Companies Act, they are supposed to follow this Rule 8, and it's statutory requirement for them to follow it. What is important is that we understand that this rule makes it very, very clear that the limitations, disclaimers, caveats can only and only be to the extent they explain, or they I should say they explain the limitations faced by the valuer in conducting the valuation process. And it should not be upfront disclaimer that I'm doing this valuation but I'm not responsible for it. I am I have been given this assignment, and as per the engagement letter, I am given only 5 days to do this valuation report. In these 5 days, I can't do a good job. So this can't be a disclaimer. When you're taking an assignment as a valuer, you are, of course, when you're taking the assignment, any delays which are not on part of the valuer, or any lack of information which is not on part of the valuer, is what the valuer can give as a limitation. But if prior to getting the work, prior to defining the scope of work, it was amply clear that this is the kind of work that is expected out of the valuer within this much time, and within with this much fee, then you can't go and say that my fee was less, my time was less, and therefore I couldn't do more work than what I've already done, or put in more efforts into the valuation engagement. And of course, you have to follow the international valuation standards. You have to follow the requirements of a valuer report under Rule 8. So all that is, of course, necessary. So there was a committee of experts set up. This committee of experts was given the task of developing a standard template for disclaimers. They submitted the report on 7th April. It was circulated between RVOs, and then finally, basically, objective is to provide guidance to registered valuers in the use of caveat, limitations, and disclaimers, which shall not be used in a valuation report. Then guidelines issued under Rule 14. So these guidelines have a statutory backing. These guidelines have to be followed because they are issued under Rule 14 of the Rule 14I of the company's registered valuers and valuation rules. The structure, so three sections of this report. One, the first starts with a brief introduction on the need for caveats, limitations, and disclaimers. It is important to go through all these three sections because all these three sections are almost in continuity. The second section, that is guidance note on use of caveats, limitations, and disclaimers, talks about a lot of and gives a lot of examples of various disclaimers, caveats, limitations, and an illustrative list of caveats, limitations, and disclaimers for each asset class is also provided after that, which is a brief list and which also has a lot of disclaimers, caveats, limitations, which are given as sample CLDs for the use by valuers. What is the need for caveats, limitations, and disclaimers? Again, we have already talked about this part. That what does Rule 8.3 talk about? And we are very sure that anything that goes or that is even issued by valuers as part of the valuation report under this guidelines has to follow this rule. The sample disclaimers, limitations, caveats may not be applicable in every case, but what is applicable is that it should make sense that you must not have received certain information. There must be some natural limitations of the valuer's job in issuing the valuation reports. So all that is something that of course we will talk in detail. Then the guidelines move to talking about limitations, and they talk about the fact that limitations arise if the RV is unable to obtain sufficient information and explanations considered necessary for the purpose of valuation. Now, this part is very important. So, if the resolution professional, the banks, and other users of valuation reports are able to establish that there was sufficient information or explanation or opportunity given to the registered valuer to do the physical verification of the assets and other processes that are involved in the valuation exercise, then these limitations can be reduced, because then you're reducing these inabilities of the registered valuer. Where such limitations result in the RV being unable to carry out the valuation in accordance with the normal approach to valuation, the valuation report shall be modified with a paragraph setting out the nature of circumstances giving rise to the limitation. So this is very important, because this is basically the pretext of all the examples that are given, and you have to satisfy this criteria as a registered valuer to give any limitations in your report. Talking about disclaimers, disclaimer is required in a valuation report to mitigate the potential risk of the registered valuer. Now, here it is very clear that the reasons for providing disclaimers in a valuation report can be the following. So, the disclaimer can protect the rights of a registered valuer by cautioning and dissuading others when using the contents of the valuation report. So, if I have to give an example, I can say that. Say I can say that I did not receive a fixed asset register as part of the valuation exercise that I did, and therefore I have done the physical verification of the premises, and I have seen the physical machinery, physical assets available, tangible assets visible at the premises that I was told which belong to the CD. I have done limited verification that these assets really belong to the CD, and I am therefore cautioning you that in case the assets that I have listed down in my valuation report, and if these assets are not found to be owned by the CD in future, then I will not be responsible. So what you're doing effectively is that you had a limitation, that you had a you had a doubt, you had a lack of information, and the valuer in this case is in the valuation report giving a disclaimer saying that he will not be responsible if some user of the valuation reports takes a decision to decision based on the valuation report, and future finds out that the assets were not even belonging to the CD in this kind of a scenario. So maybe we can discuss other examples on the go, and we can also take some of the comments or questions from the audience, from the delegates. So the second part can be a disclaimer limits the liability of a RV, since it serves both as a warning and a way to mitigate risk. A disclaimer protects an RV from liability. Anyone who reads the disclaimer should understand the risk involved in using the valuation report. So again, when you're sharing the draft valuation report with the resolution professional, bank, or other users of valuation reports, what happens is you're essentially giving them an opportunity also to go through those disclaimers, go through the other things that you've written in the valuation report, and come back with any comment from their side. So, of course, in an IBC, in a CIP process, in a liquidation process, the RP or the liquidator is the person who will be reading through that report, and if the RP or the liquidator feels that there is any information that is available with the CD or with him or her, and he can share it with the valuation professional, then it will help in limiting the caveat, limitation, or disclaimer in the report. So it also limits the liability of the RV. The last point is more or less similar with part B, therefore I think I can miss it out. Uh, Coming to the next part, we need to understand. that a valuation report, the guidelines say that the valuation report should not carry a disclaimer which has the potential to dilute the responsibility of the RV or makes the valuation unsuitable for the purpose of which the valuation was conducted. The valuation report should be capable of being tested through the crucible of legal evidence and judicial proceeding. So this is another condition that they have imposed, that in no case, of course, practicality needs to be looked into. If there is lack of information, lack of documents, and there is no other way to corroborate the facts or corroborate the evidence, then the valuation report, of course, will carry a few disclaimers, limitations, caveats, which can be used by the valuer to protect himself. But otherwise, the valuation report should not be such that it is maybe giving an opinion, giving a value, and it should be capable to be tested through the crucible, through the judicial proceedings, through the court of law, through NCLT, NCLAT, other authorities, and it should not be just a number or just a few words. It should be having a background. It should be talking about the full story of how the valuation was conducted and how the conclusion was arrived at. And RV may, so the following points may be considered. So the RV may consider, identify the rights that he wants to protect, identify the areas where she might be subject to liability, clarify that the contents of the evaluation report pertain to specific use by the company, and caution the reader of the potential risk. Uh, Again, they have clarified once again, they've clarified it multiple times before, that a disclaimer will not by itself be able to exclude a RV's liability in respect of negligence in performance of his duties. So the RV was supposed to do or expected in custom or expected as per the engagement letter, expected as per the scope of work given by the resolution professional, and he did not do his job properly. He was negligent towards his duties. He did not do a proper physical verification, which is mandated under CIRP or liquidation. Then the RP cannot be the RV's liability, registered values liability, cannot be limited based on the disclaimers that he has given. So, guidance note then comes to the requirements from a valuation report, and it says that a detailed and fully reasoned valuation report should be prepared in every case of valuation done in respect of both mandatory and discretionary valuation. So, please note that it is not only talking about the valuations that are required under statute, under Companies Act, IBC, or other acts. It is also talking about other uses of valuation where the registered value registered with IBBI is giving a valuation which might be discretionary. And they've listed down quite a few discretionary valuation reports like FEMA, for even I think they have covered FEMA rules. Then they have covered SEBI. They have covered quite a few discretionary valuations where it is not as per law or required as per law, but they have said that these guidelines are also applicable on those discretionary valuations. So the following aspects need to be considered. They have listed down contents of a valuation report that must be there in the valuation report. So if these contents are missing or these contents are not given in a clear manner, then there will be these disclaimers may not be able to protect the valuation professional, the registered valuer. Procedures involved in preparation of a valuation report. They have also listed down the normal process of preparing a valuation report, which was not available so far. This is a fresh perspective that they have given. Although it is something that is known to various registered valuers, this process will also help the users of valuation reports understand the process followed by registered valuers, and then give information or provide support accordingly. Then, of course, it talks about caveats, limitations, and disclaimers and what can be given. So these are the contents of a valuation report. The ones that are not read are part of Rule 8 already. And as part of Rule 8, these are something which were mandatory to be followed even before these guidelines. With respect to the red ones, these red ones are the ones that are already part of international valuation standards or other ICI valuation standards, which are already being followed by valuers. So this is a list. I don't think I need to go through this list in detail, but this list is important because every valuation report should have this, and it should be in a clear, unambiguous, non-misleading manner, consisting with the need to maintain confidentiality. And this is the requirement, and it is a requirement for transparency and principles of good corporate governance, that all these need to be part of valuation reports, and this will maintain good standards for any valuation report if one follows and brings in these contents as part of the valuation report. And it also includes caveats, limitations, and disclaimers, which are also required to be part of as part of the contents. Moving to the procedure involved in preparation of valuation report, the principal procedures adopted by the registered valuer in carrying out the valuation should be set out briefly in the report, and such procedures, they say, typically include. So these procedures may not be mandatorily required, but these are typically involved in a valuation exercise where you review past financial statements, then you review and analyze financial projections, the future projections that have come to you or which you have prepared. You do an industry analysis, you do a SWOT analysis, you identify the strengths, weaknesses, opportunities, threats which are applicable to a business, applicable to a company, a CD, comparison with similar transactions, comparison with other similar listed companies. All these are procedures that are normally followed. Then you have discussions with the management or the RP or other RP's office, other users of the valuation reports, maybe the banks. You review the principal agreements documents. You do a site visit. You can see the site from outside as an external visit. You can do an internal site visit, or you can do both. You can do a desktop valuation. What is a desktop valuation? A desktop valuation is principally called a valuation where you are not supposed to visit the site physically. Now, in all CIRP matters, liquidation matters, you're supposed to visit the premises. It is a requirement for physical verification of the assets of the CD. But in some cases where maybe there are no tangible assets, no plant equipment or inventory, there maybe it is a desktop valuation where you are identifying the future income capability of any business and doing a valuation. In those cases, it can be desktop valuation. Any assumption made or for internal condition must be stated, like in case of a desktop valuation, and the RV must state the basis of the report as photographs, documents provided. So once all these information can come to you sitting at your home, and then you have to say that yes, I relied on all this information, and what was the process of collecting it, whether it was collected, whether the site identification was done by yourself, by your team, with the help of any representative of the client, or by the client itself. So all these are requirements that they have now stipulated in these guidelines. So the registered valuer should also include in his report an affirmative statement that the information provided and assumptions used by the management, others in developing projections have been appropriately reviewed, inquiries made regarding basis of key assumptions in the context of business being valued, and also an affirmative statement on adequacy of information and time for carrying out the valuation. Now, this is a mandate which is very, very important, and it puts a lot of onus on the valuer, registered valuer, that when he or she is issuing the valuation report, that valuation report must comply with these two requirements. And if the RV has any limitations, he can of course say that yes, I had adequate information or documents subject to these documents which were not available. And then subject to those information or those documents that were not available, then the RV can, of course, registered valuer can say that okay, I took these assumptions in absence of this information, or I relied on these alternative options that I had available with me. Then the guidelines continue and say that the registered valuer should mention any key factors which have material impact on the valuation, which should include the size or number of assets or share of the company, or materiality or significance, the minority or major holding, changes on account of transaction, impacts on controlling interest, marketability or lack of marketability, prevailing market conditions and government policy, as a disclaimer depending upon the factor. In my opinion, this part of the process will be more useful for valuations that are done under Companies Act, or valuations that are done on a discretionary basis for maybe valuing the shares of the company, where you're talking about valuing the business of the company based on future cash flows, wherever shares are involved, and understand that what is the value of these shares. In CIRP valuations, liquidation values, you normally don't see all this because you're supposed to value the overall assets of the corporate debtor. Then, in case of valuations of intangible assets, there may be an impact on the value due to faulty structural design or contamination. And based on the individual circumstances, the RV may decide how to use such information in the valuation report. So I think I'm through with the first few parts of the requirements from the valuation report with respect to the guidelines that have been issued. If there are any questions, we can take these right now, or we can then take these up once we have started discussing the caveats, limitations, disclaimers that have been given as examples in the valuation report in the guidelines. So I will continue then, and I will we can
So
take some questions later.
I can talk about some questions now at this
Mm.
moment.
Yeah.
Uh, like the questions, uh, if the site is not fully accessible due to wild growth and visible threat from pests, bees, snakes, etc., what can be the position of the valuer in such situation where the access to asset is limited but the assets are partially visible?
No, I think yes, there might be vegetation. There might be some unless and until there are some poisonous plants, poisonous creatures roaming around in an area, maybe this kind of a limitation that we were not able to visit the site will be difficult to carry out. But yes, in this kind of a case, the user of valuation report, in my opinion, should give necessary, I would say, equipment, necessary precautions can be taken so that yes, this kind of a site visit can happen. Some kind of clearing of some growth can be done, and I don't think it's a very difficult thing to be done. Anyways, the site visit is
So the other
not the
question,
site visit is
so
not only important for the registered valuer. It is also perhaps important to find a resolution applicant, find a buyer for those properties, make it a presentable property. I think it will be required in any case.
so I think the correct answer is that the RP or the liquidator should invest some amount to clear that wild growth of vegetation, and the area should be safe for inspection, because it is not only the valuer, even as Ankit said, it would be even required to be visited by the potential bidder and resolution applicants. Can the deal take place below the fair value as arrived by RV? Many cases, the investors may not be willing to cut the check at the fair value. What is the practical way? No, during the I can answer this during CIRP, as per Regulation 35, we are supposed to get the valuation done in two manners: one fair value, and the other is the liquidation value. So the fair value and the liquidation value, both information is provided to RP, and later on, when the resolution plans are received and are being considered, the same would be provided to the committee of creditors. The committee of creditors will take their own business, will use their own business acumen, and the commercial decision of committee of creditors would be valid even if they accept a resolution plan at fair value or at liquidation value or any value in between. Even the Supreme Court has held that the committee of creditors can accept a resolution plan which is even below the liquidation value. So there is no condition that the COC cannot accept a resolution plan which is below the uh, liquidation value. Due to high use of chemical, our life is at danger stage. Uh, question is coming from a valuer. From due to high use of chemicals, our life is at danger stage. So I would say that any professional should not risk his own life. Wherever he feels that there is a danger, he should rather stop there and give a disclaimer and use his experience, use the technical information, theoretical information to provide a report with a disclaimer that why the particular uh, site visit was not done because of the chemicals or any reason. Is it mandatory to visit site by RV, or any responsive team member can be allowed to perform this task? What are the guidelines, Ankit? Is RV supposed to go himself, or he can even appoint some
The
employees?
registered valuer in it is of course recommended that the registered valuer visits on his own. But if the registered valuer chooses to delegate this to a team member, he cannot delegate the responsibility. So he will have to make sure that his team member, or he has done the valuation or done the physical verification through a proper, useful channel. And one of the ways that are available these days, because everyone has a mobile phone which has a video camera in it, it is very, very easy these days to have a verification process where the registered valuer can, and especially I think it is more or less accepted during the COVID era, where the travel is difficult, and yes, there are limitations on how much one can move out. There it becomes very, very important that it can be done digitally, and in a proper recorded manner, which can be reproduced in case it is required by anyone in future.
Yes, Ankit, go ahead.
So I will
There is no
continue
more.
then.
Yeah.
Yeah.
And so basically, there is one this
See, there
part
is
of
also
the
one more question. What will be the impact of integrated reporting framework on valuation reports? This question has come from Siddharth Pal. Uh, Impact of integrated reporting framework on valuation reports. So, what is integrated reporting framework, in case we can? Uh,
maybe Mr. Siddhartha Pal is talking about the guidelines that we are talking about, and he's writing integrated reporting framework. So I think maybe he can give a clarificatory question whether he means to say the guidelines that we're talking about and how they will impact the valuation reports. So I think he needs to clarify his question.
yeah. Arushi Srivastav is asking how many times can a site be visited? Is there any limitation? There is no limitation.
There's no limitation, but yeah, we try to make it one only because visiting a
No,
site
it
is.
all depends upon, like, in case you want to spend multiple times the cost of lodging and boarding, that of course you can do.
Yes,
But
yes.
this is a depends upon the need. In case the first time information is not available, then the second time it has to be there. See, Mr. Pankaj Tibrewal is asking a question: what is the way forward if the site is not in possession of the RP, though ownership belongs to CD? Uh,
Uh, an outside visit, an external visit can be done. Some papers can be arranged from the people who have mortgaged that property. They should have some title deeds. They should have some basic documents with respect to the project, with respect to the measurements of the building, maybe from past valuation reports. So some information should be available from the RP from through this route, even if there is no cooperation from the CD or there is no document available with the CD.
so, is virtual inspection allowed as per IBBI guidelines available, or is it just the assumption because of the COVID-19?
There is no bar on virtual inspection. The law is very clear that a physical verification is required to be done by the registered valuer. And when you say registered valuer, registered valuer's office is included, very similar to how a resolution professional also includes the office of the resolution professional. And I don't see that that will be a problem. Whether, of course, it is better in case the virtual inspection can have one of your own employees, the registered valuer's own employees, to visit the premises. But where there is a limitation to travel, you can justify that there was no possibility of me traveling or the registered valuer traveling to the site for inspection. There, a virtual inspection which is well recorded, which covers the whole premises in detail, is good enough. But again, we're talking about what are the question is, what are we talking about? In case you tell me that there is a running thermal power plant, and I need to value it, maybe I will not choose a virtual inspection for that kind of a plant. But if somebody tells me that okay, there is a vehicle which is standing there at this remote place in some town in India, and that needs to be valued as part of the valuation exercise, then I will choose a virtual inspection route.
Certainly. I think Mr. Nandkishore Bhardwaj is asking a very important question. If the property is seized and attached with the Enforcement Directorate and prohibited to get visited, then how a RV can perform valuation without a visit? So, like we have been handling various cases where the assets are attached by Enforcement Directorate or any other enforcement agency in the country. While the assets are attached, the first job is to get the assets detached, and then only you can sell it. So if the assets are attached, then there there would not be any possibility of a resolution plan also. So in our cases, we have even deferred in some cases that the valuation should not be done. The valuation, of course, was done in some cases by, as Ankit said, with an outside visit. And as far as the items inside the premises, those were estimated based on the books of account and based on the other records available. Since during CIRP it is required that valuation should be done in case a resolution plan comes or doesn't come. However, in liquidation, we have an option to get it done only when this asset is ready for sale. Otherwise, we may not get it valued because we can simply do all the formalities and process using the CIRP valuation now. So I think Mr. Siddharth Agarwal was saying that he was actually saying when the chemical, environmental impact that he was trying to say. How do you evaluate the environmental impact on the items, for example, in chemical industries, inventory, or the mining and the mineral side? So that's something which is
So, in my opinion, I think I can answer this question that in normal circumstances, what happens is that you use the highest and best use principle. And what we are looking as a valuer is that the best option to continue operations or continue business for whatever you were talking about. If you're looking at a mine, and then you will be looking at continuing continuity of that mine. If you're looking at a chemical industry, you will be looking at continuing the chemical industry project, and in most cases there are reasonable safeguards that have already been put in place that these chemicals and these mining operations do not hamper the environment beyond the reasonable level. In some cases, I would say there is also this concept of site restoration fund that is created with the government of India with respect to restoring these sites to their normal system, so that they don't become areas of poisoning future human occupation. So I think that's the answer to maybe the question that he has put up.
the Pankaj Tibrewal says that what is the way forward in case title deeds of the land could not be provided? However, the unit is under possession of the RP.
I think without the title deeds, it will be difficult for a valuer to say that the assets are readily sellable. The title deeds have to be somewhere, and or their duplicate copies need to be arranged, or there has to be some way that title deeds need to be arranged.
So what we need
What
to
is your
understand,
opinion?
from the title deed is whether the land is freehold or it's a leasehold land, and of course this kind of information would be available with the corporate data or from any other source. If the title deed is not available, then the premises should be inspected, and uh, it should be inspected, it should be measured, and the valuation can be done. Title deed will only provide the legal status of the land, and that can be supplemented by the RP later on whenever the title deed is available. However, the valuer can definitely value the land based on the
So,
location,
so in
area,
this case, in this
neighborhood.
case, what can happen is that the valuer can go ahead and assume that the title deed is available, because title deed availability will also decide on the marketability of this land.
No, of
Because
course,
without title
then
deeds,
he
you
will
will
have
not be
to,
able to find a market for
so
that
he will
land.
have to give an assumption that the title deed is available. It is
Mm.
presently not available. Later on, it is
Yeah,
available.
yeah.
He will have to say that. On see like Mr. Sundrapandian Kupuswamy, only building and vacant site only in south during COVID only.
I think he's saying that some building and vacant land is in south, and during COVID, does it require a physical verification from the registered valuer? So as I said, that especially a vacant site or only a building, uh, maybe in case the comfort to a registered valuer is developed with a desktop valuation, with somebody representing him going and doing the site physical verification, maybe it can help, but it seems that there will be more information required to understand this requirement.
Uh, Sandeep Kumar Mitra, he is asking, in case the factory is closed and only security guard is there in the factory, how we can get fixed asset register in case of liquidation valuation? No, I think the getting fixed asset register is something that the promoters or the key managerial personnel of corporate debtor will provide. It is always not possible that the fixed asset register is lying at the factory site. However, as I said, that the valuation has to be done based on the physical verification, uh, actual items available and on your inspection. Then you can match it with the fixed asset register, compare it with the fixed asset register, and you can report items matching and items not available. Whatever items are available, you have to value that. So if the fixed asset register is not available, one first of all, the fixed asset register would be available from the company. So the company is not providing it. So the company, in most of the cases, in the most of the MSME, they would not provide because probably they have never maintained it. The auditor will also not provide because he would also he might even have not seen it. But then this is the difficulty we all are going through. However, I have some recommendations for the RPs while they get the valuation done. I will come out with the once this particular slide comes, then I will add my experiences into this. Uh, but still, I think Ankit, some of the questions that we can take later, you can
Yeah.
continue with these slides.
So, coming to the next part, where the guidelines have then talked about caveats, limitations, and disclaimers, and they have attempted to, in this para or this part, they have attempted to differentiate between them. So, they have basically said that the caveats are warnings or creation or cautions to the client user of services. Limitation is a restriction on the scope of the registered valuer's work, including inspection or investigation of the data available for analysis that may be present and known to the registered valuer at the outset of the evaluation engagement, or that may arise during the course of valuation assignment. A disclaimer is a statement intended to specify or delimit the scope of rights and obligations that may be exercised and enforced by the parties in a legal recognized relationship. It is a statement denying responsibility intending to prevent civil liability arising for particular acts or omissions. So they have attempted to differentiate these, but finally they have said that whereas these can have different connotations, in context of evaluation, the clauses may get used in an interchangeable manner, as limitation or a disclaimer by a RV could be caveat for the user of the report. So they say that hence it is imperative that the users of the report are familiarized about the same to enable them to assess the impact of the disclaimer caveat limitations on the credibility and reliability of the report. So therefore, the guidelines put the onus then on the users, that users should be aware of what these disclaimers, limitations, caveats are, so that in future, if they want to take any legal action, if they want to take any legal protection on basis of that valuation report, they're able to do that. And these caveats, limitations, disclaimers, maybe if they are unnecessary, should not spoil their thought process or their use of the valuation report. Any caveats, limiting
Ankit,
condition?
this is actually very important part of the our presentation.
Yeah.
In case you can explain clearly the difference between caveats, limitations, and disclaimers. Whereas the
So
limitations are very well understandable that these are the limitations while executing a job, and the caveats are very important. Caveats are warnings or cautions to the user of the report. So this is something which will highlight, the caveats will highlight all those warnings, which should be very, very prominently highlighted so that any user should consider and read these warnings and cautions before even using the report.
so I think
Limitations are understandable. Disclaimers, Ankit, can you explain
I
disclaimers?
will
Like
I
how
will
does
talk
it
about
differ
this
from caveats?
I will talk about this with some examples, and I will
Yes.
discuss all these in a little more length. My thought process is that a caveat is something where you're simply saying that हिंदी में बोले तो मेरे पास बाद में आप मत आना कि आपको कोई नुकसान हो गया, आपने मेरी रिपोर्ट के बेसिस पे कोई डिसीजन ले लिया, और मैं आज ही आपको बता देता हूँ कि मेरा स्कोप क्या है. So what can be done? A valuation report can simply say that I have gone through the photocopy of the title deeds to value this land and building, and I have not vetted or I have not, my scope of work did not include the existence of the complete chain of title documents available with the seller, or available with the company, available with the CD, and therefore I am not responsible for any decision that somebody takes based on my valuation report in purchasing that land or building. So that is a caveat where you're saying, you're giving a warning or a caution to each and every user of the valuation report, and saying that you will not be responsible, the valuer will not be responsible in case it turns out later that the title deed that was with the bank or with the CD was not the original title deed at all, was a fake document. Similarly, let me give more examples. So let me talk about a caveat where you say that you show some inability in some specific domain. So there is a concept called, there are professionals who are called site surveyors, or surveyors, land surveyors. Now, what those land surveyors can do is they have a specialization where they can visit government authorities, look at online records of various lands, and land authorities and land records available with the state government or other authorities, and then try and reconcile if some building which is situated on at some place is situated on the land that is owned by somebody or not. So now, many people, many land and building valuers say that we are not surveyors. We visited that site. That site had a boundary, and there were few buildings that were part of that building, part of that boundary. There were no claimants of that land other than the person who claimed to be owning that land, who we have done this valuation for, and we have therefore assumed that this building belongs to this person, but we have not taken any opinion from any independent site surveyor. Neither did we have any site survey report which talked about, or any site surveyor's map, authorized map, which can easily give us the confidence that this building was indeed situated on the land that is owned by the owner of the land. So these are some caveats that I can give an example, and I think when we go further, I will be able to give more such examples. So what I'm trying to say is that when you give a limitation, so like, let me now come to a limitation. So say maybe the limitation that you came across was that the example that sir gave, that due to high vegetation growth, poisonous plants and poisonous animals on the vicinity of that plant, one could not do a physical verification of that site, and one's evaluation was then conducted based on whatever limited site verification, physical verification from the outside one could do, where one could see the buildings, see the structure, and all that. So one could perhaps see Google Earth, one could see Google Maps, one could see maybe some satellite photography of what is there on that land. But what you're doing, essentially, you are putting a limitation, and then you're giving a caveat that whoever is will be using the valuation report. Effectively, you're also giving a caveat where you're saying you're giving a warning that there was this problem at that site, and my valuation report may be erroneous to the extent that I was not able to do this process which was normally expected out of the registered value. So the limitation also becomes a caveat. So therefore, the guidelines also say that these are interchangeably used in valuation reports. A disclaimer is more like a statement which says that I say that I declare that I will not be responsible for any claims, for any liability, or for any expense incurred by somebody using my valuation report. So you're giving a disclaimer. You're saying that if something of this kind of something goes wrong, my valuation report turns out to be wrong, my estimate of value turns out to be wrong, it is an estimate and the actual transaction happens at a very very different value, then one can say and one can claim that I will not I give a disclaimer that I will not be responsible for any claims which come to me if somebody loses any money because of any decision taken on behalf of my valuation report. So that is a disclaimer. So basically saying that there is a legally recognized relationship, and one says that I don't accept any civil liability against me if somebody goes ahead and uses my report for this purpose. So one of the disclaimers that is popularly given in valuation reports is that the valuation report or the valuation number will be valid only and only for those uses for which the valuation report was taken. So, for example, if somebody comes to me and says that, okay, I want the liquidation value of this property. The property is in liquidation. He wants a liquidation value. Now, one the person cannot come back to me later and say that you gave me the liquidation value, but the fair value of the property was much higher, and therefore I have been caused a loss due to this problem. And you give me you should be now liable for whatever damages you have been caused because of this problem. So one needs to be very, very clear. The disclaimer given by valuers in their valuation reports popularly are, which say that this is only for the limited use that is stipulated in the report, and it will not move beyond the stipulated use. So if I give a report today and say that my report is being issued for the purpose of finding the market price of a property, and the person ends up using the report to recast the value of that property in their financial statements, where I have expressly said that that is not the purpose for which I am issuing this valuation report, then I can put in a disclaimer and limit my liability in case somebody uses my valuation report for a different purpose. So questions on caveats versus limitation versus disclaimers. So I will move forward if there are no questions. I hope,
We can move forward.
yeah,
Yeah.
we can move forward in the meantime. So the caveats, limitations, and disclaimers have, of course, we have talked about different connotations, and we have also said that any caveats, limiting condition, or other disclaimers to the report must be clearly stated with appropriate specificity. It should not be vague. It should be very, very clearly stated. So then the guidelines very, very clearly say that the registered valuer shall not disclaim liability for his expertise or deny his duty of care. And however, it is recognized that an RV may prepare valuation report of the company based on information records concerned as provided by the management. The management remains liable for the correctness and veracity thereof. However, significant inputs provided to the RV by management owner should be considered, investigated, and or corroborated. In case where credibility of information supplied cannot be supported, consideration should be given as to whether or how such information is used. So even international valuation standards are very, very clear. They say that no matter what information comes to your table, you have to use your own intelligence. The valuer has to use his own intelligence to corroborate it, to make sure that that information is worthy to be made part of the valuation report. If tomorrow somebody tells me that during COVID times, okay, the management comes to me, a management of a restaurant, and says that during COVID times I will have a 500% jump in my sales. Now, of course, in hindsight, you can say that that's not possible. But even otherwise, a valuer is expected to say that, okay, will people continue to eat food when there is a risk of COVID in the market, in the society. So, what I'm trying to say is that your common sense must prevail. Your ability to consider, investigate, and corroborate evidence that comes your way, comes to the registered valuer, should be there. The assumptions that you're taking as a registered value should not be hurting other people's intelligence. That how come this can be possible? It should not be an impossibility. So, moving further, the RV does not make or calibrate the projections, but factors his response and valuation assessment on the reliability and credibility of the information. So, one can get management projections, future numbers, maybe 5-year future, 10-year future. How will the company grow? What will be the sale? What will be the costs? What will be my profit, cash flows, and how you will like to discount them to today's present value and come out with a value. But the RV should consider the reliability and predictability of the projections after testing the assumptions, and sufficient inspection, inquiry, computation, analysis should go into the report. And the RV may disagree with the projections if they are conjectural or bordering on the unreal, and accordingly make necessary modifications. So it is not required, it is not compulsory that the RV should follow the management given projections. The RV can say that this management given projections are nonsense. I don't go with them. I have seen the industry, I've analyzed the industry, I have done my study, and I feel that the growth of this company in turnover cannot happen beyond this percentage, whereas the company has given me numbers which talk about this kind of a growth. I don't agree with it. So that is possible. The
So, Ankit,
RV,
should I ask one
yes, yes.
a very important question? Is like in the case of enterprise valuation,
Mhm.
the valuers are not supposed to make projections. They are not supposed to arrive at the EBITDA, or they are only supposed to verify it as the information is provided by the. Because
So
see, in the
the
case of insolvency cases,
Mhm.
there is no promoter who actually would provide us all the projections, and the promoters, of course, and the KMDPs also, we are not sure whether they would provide. So, according to the guidelines, the RP should make the projections, and the valuer, the RV, should check it. Is that the mandate?
No, that is not the mandate. That is the normal scenario in case of valuations that are required under Companies Act. So these guidelines are not only for the use or under IBC. These guidelines, we should remember, are for all possible uses of valuation reports.
Hmm.
And wherever a company is getting a valuation done, maybe for any fresh issue of equity, maybe for other purposes under the Companies Act, there is a strong possibility that information will come in from the management on the management's opinion on what will be the future of the company, what will be the future revenue, and so on. What is important to understand is that in case of insolvency cases, in most cases where we have done valuation, we have ended up making the projections ourselves. And if the management is not able to provide any number with respect to the projections, the registered valuer cannot simply say that I will not do an income method because the numbers are not available. The expectation is that the registered valuer should be able to make a model, come out with a number, and have confidence in that number based on whatever assumptions he's taking with respect to the discount rate, terminal growth rate, and all the other assumptions that are required in a DCF method.
Hmm. Fair enough. So, we also have a couple of questions which can be taken now or later.
We can take them now.
So, is there a possibility that the RV, before accepting the assignment, take a detailed look into the ensuing scope of work so that a few of the risk eventualities foreseen can be taken care of beforehand as a result of the number of CLDs can be reduced in the final report? I think it's a very, very simple question. It is just definitely the valuer, the RV should accept an assignment after developing an understanding about the assignment, and that actually will reduce the CLDs. That's very clear. Uh, the other question which has come from Mr. Naresh Kumar: Can RP recommend to change the CLD mentioned in the report? It is not recommendation. I am not saying that the recommendation word is correct, but what RP can do, RP can discuss about the limitations and can provide that information so that the limitations are removed. Now, if the scope of work which is different, and based on the scope of work, there are some disclaimers, and those disclaimers are also supposed to be discussed with the RP. And in case something which is unreasonable can be removed. Similarly, everything also applies on the caveats.
From our practical
So,
experience, what we have seen is that in many cases we have issued the draft valuation report, and the RP has come back with extra additional information documents, and got some of the limitations disclaimers given by us removed.
so the question from Arun Lakshmana Rao is: in a site visit, a part of the unit is locked and not allowed, or valuation and not allowed for valuation, and no reason assigned. Uh, my understanding is, in case of any such limitation, the valuation can be completed based on other information available. It should be very clearly mentioned that this particular limitation, we faced this limitation. It should also be mentioned that what is the basis of the valuation done, what are the documents relied, and what could be the impact of this limitation. What could be the impact of this limitation? If this is mentioned in the valuation report, that will be considered as as if the RV has done a good job. Uh, Venkateshwarulu, I think again the same question, like can the deal take place at fair value due to market conditions? So
But his
that I have
question,
already
I think
answered.
his question is not with respect to an insolvency case. I think it is otherwise. So my thought process is that yes, if there is no legal requirement to follow any fair value, then it should be allowed. If it is not an insolvency case, I don't think there is a legal
Yeah,
bar on anyone selling anything below fair value or something.
yeah.
So let me
Yogesh
move
Kumar
forward.
Singh is also,
Yeah,
yes, yeah. Please
we
go
can
ahead.
take up more questions later. So the RV, then the guidelines continue to say that the RV has the right to demand relevant information and basis of the projections before commencing, and it is a duty of the entity being valued to be fair and to provide accurate information about the subject asset. So this is something that is again stated, maybe keeping in view that the company is getting the valuation done. Wherever the company is not getting the valuation done, expecting the resolution professional to provide projections, I don't think that's very real. But yes, in the past, in our experience, we have always given the management of the CD opportunity to come back with any projections that they want to share with the valuer, which they want the valuer to consider. In a valuation report, the RV can state that the assumptions are statements of facts provided by the company. However, they say that the guidelines simply say that a warning statement should be there, because at most times what happens is that the data that the registered valuer is using for his valuation report is used and in continuity with his own opinion. So they said that they should data should be provided by the company, and it should be there should be a warning statement that this is the data that is provided by the company and this is not our data. And then sufficient inspection inquiry, the same wordings have been repeated, that it must be properly supported, that yes, there was a proper due diligence done on those details. Then it says that all valuations are to be carried out in sufficient detail to comply with the requirements of due care. Then it says that significant concerns regarding the justification, information, or the time available to complete the valuation be stated in the valuation report, together with the appropriate explanation and implications. So all this should also be there. It should be very, very transparent. Effort, diligence, and level of expertise applied by the relevant registered valuer need to be stated in the valuation report. These are the illustrative caveats, limitations, disclaimers that are not to be used expressly. So these are very, very important for you to go through this as resolution professionals, banks, the users, that these CLDs should not be part of your part of any report. So the first one is that business plan forecast received from the client. So the RV cannot give a disclaimer that the business plan forecast received from the client without applying test of reasonability and due care. So he cannot say that I have received this, I have used it, I did not use my mind, I did not apply my mind to these projections or business plans or forecasts given to me. Physical verification, are we giving a disclaimer that he has not physically verified the tangible assets in case where engagement is for providing liquidation value? So, in case they have very, very clearly said, I think this is very, very relevant for IBC, where they have said that you can't give a disclaimer. RV cannot say that I did not visit the site. So, a liquidation value matter, they are saying that the physical verification is a must. Market related data, are we giving disclaimer for the market related data employed in his reports, example beta, discount factor, comparable companies, comparable transactions, valuation matrices, without testing appropriateness of the same? Historic analysis, RB cannot say that, cannot give a disclaimer that I have not done any historic analysis. So, historical analysis is a very, very important part of a DCF approach or a normal valuation also, where you conduct and see that what has this company been doing in the past. So, say from our example, if we concluded that the company has no running operations over the past 3 years, you can have a very, very different approach. You can totally change your approach to the valuation, but where you see that the company is an active operation and on the date of the valuation also, then it will make totally different sense to go ahead with the proper historic analysis. RV cannot give valuation conclusion based on only one approach without giving any reasons as to why the other two approaches were not considered. So this is a very, very remarkable thing that they've done. This is also, of course, part of the IVS, International Valuation Standard, that registered valuers were supposed to follow. But now it is very, very clearly spelled out that you can't say that I did income approach and I'm not responsible and I will not comment on why I didn't do market approach or cost approach. So you have to talk about all the approaches that can be applicable to a valuation assignment, and then talk about why you have not used certain approaches and why it did not make sense to you. What was the logic behind not using those approaches? Not that if you use those approach, you have a compulsion to use them. You can make a report. We normally do that, where we test the various approaches that are available: cost, income, market, and then we say that yes, this approach is not giving a proper result because of possible these results, or these reasons, and therefore we are disposing it and we are using this approach. Another expert, so are we giving disclaimer for work done by any expert and the findings of the same does not form part of the report of the RV? So you cannot say that I have trusted on another valuer's report and you say that I therefore disclaim all my responsibility for maybe the land and building value or maybe the plant and machinery value, which has been made part of my valuation report, without making that report part of your own report. So this is what is not to be used. This is the list that they have given of CLDs that are not to be used. And we can discuss at length if there are any questions on any of these. Because this is important part of what should not be there in the report, what CLD should not be there. Moving to illustrative CLDs for all asset classes, the first CLD that is listed here is with respect to the purpose. I've already given this example that it is normally very, very normal for valuation to be done for a specific purpose. And if you're doing the valuation for some other purpose, then the valuer can easily say that I'm not responsible in case this valuation report is used for some other purpose. I have done it for this purpose, and that is what it should be used for. The second one is responsibility of the RV. So he can say that my responsibility is only towards my client, towards the authority under which I have done this valuation. I will not be responsible for somebody else. So say a company comes to the RV, asks him to do a valuation report, says that okay, I need the valuation report for finding a buyer in the market, and he gets the valuation report, the company goes to the bank and says, see, this is a report which is from a registered valuer, and you give me a loan. And the bank gives a loan on based on that valuation report. Now the registered valuer can claim a disclaimer and say that my report was only and only meant for this purpose. I have stated that purpose in my report, and it was not supposed to be used by any other person apart from the person who I issued the report to. So therefore, there can be a limitation on the scope of work, or the scope of the usage of the report, even through the user, limiting the user of the report. Accuracy of information. So basically the registered valuer can say that whereas we have done our analysis of financial information accounting record, but we were not supposed to audit. So you have to understand that an audited financial statement is an audited financial statement, and a registered valuer is normally in all circumstances not expected to go deep and start auditing the books of accounts of a target company, or a entity which is supposed to be valued. So then we do not provide assurance on achievability of the results forecasted by the management. So wherever there are some results forecasted by the management owners, of course you can say that yes, we have done our own due diligence, but the actual results may be very, very different from what has been projected as part of my valuation report. Post valuation date events, you can say that the you can simply say that the basis on which the valuation has been done is based on the valuation date. Any events which have happened post the valuation date, we cannot consider them. This is a normal system in valuation, that because valuation involves forecasting the future as on a particular date, and then anticipating the future cash flows and all that. In several instances, you will find that the actual result is very different from the forecasted result, and that's where the industry experience comes to, that the valuation should be accurate, but wherever it is not possible to be accurate, this kind of a disclaimer can be given. The range of value estimate. So there is a concept in valuation amongst many valuers that the valuation should be a range, because the assumptions are different, the assumptions can vary, the discount rate can be anywhere between 10% to 15%. So how can the valuation be one? So there, if they're talking about a valuation bracket or a valuation number range, then you can give this kind of a disclaimer, saying that we have tried to give one number for the use in the reports, but in normal situation valuation is a range. No responsibility to the actual price or subject asset. So you can say that yes, I have given a estimate, but if the actual transaction happens at a different price in future, I will not be responsible. Reliance on the representation of the owners, clients, their management, and other third parties. The client owners and its management representatives warranted us that the information they supplied. So basically, you say that the owner, client, or the people who gave us the information have given it, and we have trusted that it is best of their knowledge, and we are not responsible in case somebody incurs a loss because of wrong information that was given to us. No procedure to to be performed to corroborate information taken from reliable sources. So one can say that yes, I have taken information from external sources, maybe from the MCA data, maybe from some website, maybe from other sources, and I have tried to corroborate this information, tried to take it and accept it in my make it part of my valuation report as if this information correctly, but there might be something wrong in the source, and I am not responsible in case the source is wrong, but I have tried to take it from the source. If the MCA data gives the wrong information, then maybe you can't make the valuer liable for the same. Compliance with relevant laws, you say that yes, I am issuing this report, and if there is any requirement for me to go to a court, follow any local law, be part of any litigation, then yes, that is not part of my scope of work, but I will have to do whatever is legally required as part of that activity. And yes, you can always talk about some additional costs that will have to be borne by the user of the evaluation report in case such a occasion arises. Multiple factors affecting. So you say that yes, there are many factors, and not all those factors can be considered. Management capability, present and prospective competition. So yeah, there's a long list of factors that can be that can influence the valuation in future, which may not be able to be factor, which you may not be able to factor. Future services, including but not limited to testimony or attendance in courts. So, this is again something that we've already discussed in the last part. You can say that, yes, I am not responsible for any testimony, but if something is required by law, I will have to be there, and the cost will have to be borne by somebody who has used my report or somebody who has paid for my valuation fee. Unavailability of information as on valuation date. So this is again something where you don't have the financial statements as on the date of valuation, and you say that, yes, I didn't have the information and I have therefore used the valuation information available on a particular date. Tangible assets, I think, Rakesh, you can complete,
Yeah.
you can quickly run through this part, and I will keep changing the
Mm.
slides.
Yeah. Thank you, Ankit. Practically, what we have seen that IBBI is now mandating that everything rotates around information and expertise. The information that is made available, gathered, and expertise of the valuer. Now, if we go to the here, the IBBI has kindly consented that the expertise of the valuer is also now limited to certain extent, and that is why they have come out with the limitations and CLDs. There are 12 CLDs for the land and building, 10 for the plant and machinery, and 9 for SFA. Now, for land building and plant and machinery, they are more or less in common, and we will not be going further in detail, but I will just briefly tell you what are the important parts that we need to check. Title deeds, it is not mandated that they are checked from the registrar's office, as we have already discussed. It may be done, it may not be done, but it is not mandated. Legal and other issues, the business perspective has been considered, and various corporate strictures beyond the limited information are not envisaged. There are many minor legal issues or like legal uh, uh, complaints that may have arisen in the normal course of business that are not considered if they are not in the normal business practice. Sketch plans and photographs, generally we go and make photographs, videos, and then attach it to the reports, and these are only for guidance purposes, and it is clearly mandated that a valuer is not a surveyor. He is not assigned to do that job, but if he is a surveyor, then of course he can complement his own report in that fashion. Then latent defects and warranty, they are almost similar in nature, that yes, the physical inspection is being done by the valuer, but what is intrinsic to the machinery, to the structures, it is not in his prerogative, because he's neither a structural engineer, not a neither a specialist for the design and application. So if an equipment fails after what he has inspected and has submitted his report, then the warranty part is not covered in any way by the RV. Then there was a question earlier also regarding the hazardous conditions. Now IBBI has come out that if there are any hazardous conditions or materials, then it should be the prerogative of a specialist or a consultant, environmental consultant, who should be taken the help of. And if the CD or the RP has already employed a consultant, then they can be referred to. Accuracy of architectural plans. Again, as I said, the sketch plans and photographs, if we are additionally including, they are only general illustrations. Whatever has been provided by the CD stands the merit, and they should be considered for any further purpose. Validity of permits and licenses. RV has not made a specific compliance survey or analysis of the various permits and licenses. Whatever local laws, etc., are to be followed, it is construed that they have been followed. The land use or any such zonal usage, etc., has been considered, and valuer may or may not go ahead and do the cross check for that. Continuation of subject business. We have assumed that the business continues normally without any disruptions due to statutory or other external internal occurrences. Whatever projections or DCF has been prepared, it will not consider whether there are any strikes or maybe there are certain changes in the law which inhibit further use continuation of that business. Independent third party, we are not advocates for any concerned party for dispute, and this is particularly in relevance when we have a case where the majority and minority shareholders have difference of opinion and they want to part ways. And generally also, we should have no tie up and no success fee wherever concerned. Valuation assumptions made by us, we have made certain assumptions in relation to facts, conditions, or situations affecting the subject or approach to this exercise. And we have not verified as a part of the engagement a supposition taken to be true. Like Ankit ji said, we have to verify and it should stand the crucible of justification. Site survey. Now we are coming to the examples for land and building. I think we have already covered this aspect. Site survey, survey
You can simply
qualification.
skip the
Yeah,
ones that are duplicate, and a lot of
yeah.
them are in the
So
second part and the third part.
yeah,
So
these are all duplicate.
any unique
Hmm.
ones you can take up, of course.
Yeah. Tenancy details, yes, extent of investigation, lease documents, and other supporting documentation may be considered. And if some lease agreements are on way, they have yet to be concluded, then the RV has to be very particular and put a condition that they have to review the exercise once the lease agreements are complete and duly executed, signed, and stamped. Environmental conditions and contamination. Now, there have been many cases where the flooding, contamination, or conservation of flora and fauna, they have all been a part and had an impact on future valuation. And definitely, there is an increasing awareness. So, this aspect has to be taken care to some extent, but definite and the RV can put in a disclaimer that yes, we have done to the best of our knowledge. Now, environmental issues and asbestos, pest infection, cost of decontamination, all
This
these
is something
should
which is
be
very,
put
very
as a
specific,
disclaimer.
which is very, very specific, I guess, for a few industries. So
Yeah,
I think this can, of course, be
mm,
discussed at length later.
yeah. And again, structural integrity, we have already discussed. We are not, RV is not a structural engineer. Valuation of under construction properties also, again, if there are some, then the RV can put an assumption that he reserves the right to have a final visit and final consideration once the construction is complete.
So this is something which they have
Mm,
issued, but I guess
mm,
that practically speaking, if an RV today says that yes, there is a real estate project and that real estate CD is supposed to be valued, then you can't really go after the project is complete to revalidate your valuation report. It will not make any sense. Maybe it will make sense for other consultative valuations that might be required in the industry, but my opinion is that for an IPC kind of an assignment, you have to
it
provide
will
the
be difficult.
information. It will be difficult to
Mm,
say that, okay, I will revise my valuation estimate after the process is through. Very, very difficult.
mm. Next.
These are all
Uh,
related to under construction property, which talks
Same,
about
yeah.
satisfactory completion, inspection, and all that.
Mm,
And then it gives an example of how you can give a caveat on that.
yeah.
Then these are some for all asset classes, and these talk about how the information has been evaluated, and broad inquiry analysis review has been done, and due diligence or audit of the information provided has not been done. Then it talks about independence. I think we've already talked about it briefly. Then it
Yeah.
talks about purpose mentioned above, so it should be only for the purpose. You've also discussed this. Then I think this 1 and 3 are also repeated.
Mm.
Rakesh, you can take up second in case you feel they have already not talked about it.
Legal matters also we have
Yeah,
discussed,
legal
and
matters are also
mm,
discussed. Yes. So
yeah,
um, physical condition of the improvements, I think you've already discussed.
visual inspection has been done. No engineering
Mm,
test done. Structural plans we have covered. Compliance issues, licenses also we have discussed.
this one is
Then, yeah.
important on all cash
Mm,
basis. So yeah, this is something that is we can discuss it briefly. That yes, we are only talking about in cash basis. So whenever you do a valuation, you have to talk about valuation currency. And in valuation currency, you have to talk about what value or what money are you valuing it in. So whenever you're doing a valuation in India, you will be valuing the whatever value you'll be arriving at will be on the basis or the assumption that yes, it will be sold in cash, whatever you are talking about, whether it is a business as a whole or whether it is some tangible assets, and how that what cash will be realized from the sale.
yeah. The ninth part, and the actual realizable value entirely depends on the demand and supply of the same in the market at the time of sale. So our reports are primarily and on the date of valuation. So future market conditions have to be looked at, but they are not a part of our. They are only assumptions for us. Then for plant and machinery, again, the information that we have, the fixed asset register that we are made available with, that is the most important part for a plant and machinery valuer. The what is the operational data and maintenance schedules, they need to be known to have a correct estimate of the balance life. The machinery tools and whatever the tangible assets, they are free from any encumbrance, and there are no fraudulent acts or misrepresentation on the part of the directors or employees of the agents. That is very important part, and this needs to be put in writing by the P&M valuer. Premise of value we have discussed, and identification and description and physical verification has been discussed, and it is not a warranty. This also we discussed earlier.
No hazardous condition is again
Yeah,
repetition.
it is again, we can
Express
go
no
further.
opinion as to how closely the actual results will correspond to those project
Project
forecasts. Again, non-cash, again, all cash is
non-cash.
something we have discussed. This is also discussed already, the demand and supply. From
Yeah.
SFA point of view, I will just quickly run through this. So it again does not include an audit. The same points will be subjective and dependent on the exercise of individual judgment. So basically, it says that it's not a precise science and conclusions. Then it says that actual market price achieved may be higher or lower based on the circumstances of the transaction. Then it says that analysis which has been done is based on the prevailing stock market, financial, economic, and other conditions. So the conditions, so basically pre-COVID, could somebody say that the valuations will drop for all the assets or maybe most assets in the country? So before COVID, nobody could anticipate that. So basically, every valuation report will carry this that okay, we have assumed everything as on the valuation report, valuation date, and we have not talked about what happens thereafter. Several factors, example, management capability, present and prospective competition, yield on comparable securities, market sentiments, all these are several factors which may not be predictable. Unavailability of information, we have already discussed this, that financial data may not be available as on the valuation date. So I think now we can come to the unique challenges of IBC, and maybe we can all discuss on how we can limit the disclosures, limit disclosure disclaimers, caveats, and limitations in the valuation reports. Of course, IBC, there are unique challenges which are listed here in front of you, and we can further discuss beyond whatever we have discussed already on how we can limit the limitation of information being a reason for disclaimers and CLDs in the report.
So, see, how would you like to discuss, Ankit, one by one, in case we take up limited or no access to documents? I think this has already been discussed in case there is a limitation on availability of documents, information. So, the assignment under the IBC has to be completed within the limited time available. So, there is no other option except to go ahead with the limitations, as we are saying, appropriate CLDs. It has to be completed. However, while we are saying that if the information is not available, it doesn't mean that the RV should not even try to get some information from the public domain. He also should be able to use his own personal experiences of past so many years. He can also collect some information from market, so that he can actually do some kind of comparable analysis of such kind of industry or such kind of land or such kind of plant and machinery. So the limited information, limited documents uh, should not impact on the valuation to a great extent. So, in case it is impacting to a great extent, means that the valuer himself is not confident that this value, if it is A, so the actual value can be A plus A, or it can be even A multiplied by 4 or 3. Then I think this is a very, very important caveat. So, it has to be highlighted at the front of the report that this particular using this report is riskier on account of the following caveats, and those caveats must mention that these are the assumptions which are very, very risky, and if you are using this report, this actually you must consider these factors, and you may you may appropriately modify the report based on the information now available with you. So in the insolvency process, we also have limited time for getting the valuation done, and especially during the COVID period, we actually have faced a lot of difficulties because the valuers were not able to travel to far-fetched locations, and the valuations got delayed. Compromised or exited KMPs, of course, is very important part. The KMPs are not cooperating. They are not providing information to registered valuers. Rather, they are providing filtered information. Now, the filtered information is focused towards negativity, and they are not giving any positive information. And the only objective is to get the liquidation value to the lowest possible, because see, they probably would see see, like, in case they are interested that the company should go into liquidation, then they will give all the false positive information. And in case they are interested in the company to be taken over by any of his, or by them, or by any of his associate or a friendly company, then they would like the asset to be valued at a lower value. We have instances where the promoters gave very, very high positive information, and the valuation was done very highly. The resolution plans were rejected by the committee of creditors later on during liquidation. Even 50% of that was not achieved, what was available during the COC, during the CIRP. So these are all the conditions which we have faced. Compromised or the exited compromise or the exited KMPs are actually playing a very, very big role, either providing information or providing negative information or providing too much of positive information. So limited or no access to premises has also been attended. There are many reasons why the premises cannot be accessed: because of the attachment, because of the possession by someone else, and because the RP is not been able to take the possession. Police help is not working. The NCLT orders are also not helping a lot. So RP has to manage all these situations uh, with their experience, with the information that the RP is able to collect from the past documents. So there is no other way Limited or no access to recent financial statements and books of accounts is a very big uh, hurdle when we are getting this current assets valued. The sundry debtors, advances, contingent assets, claims, all the amounts stuck up in litigation, all these assets needs a lot of information for getting any positive valuation. In fact, there are a lot of companies where we find that the contingent assets are having very, very big value, whereas the information was not provided to the valuer, so the valuer just valued it zero. Even the receivables are very important. In case the information is not given to the valuer will simply say the recovery is zero or the valuation is zero. uh, Challenges of a shutdown unit, of course, like most of the companies, like in case we see that most 80% of the companies which are coming, 70% of the companies probably are coming, which are basically the units are closed. So challenges of a shutdown unit is certainly.
Basically, there is no technical people available at the site,
Oh yeah, yeah.
electricity available to test any working of a machine, whether that machine works, does not work. No weighing bridges available to weigh the equipment or other assets available at the site. So these come with a shutdown unit. These challenges.
So I, based on all these limitations, I have, and based on my experiences, I would actually try like to guide the resolution insolvency professionals. First, I would emphasize that the insolvency professional must read the valuation report word by word. All the disclaimers, limitations, and caveats must be read. Not only this, the methods and the information provided there, the details which are required, that must be read. So, in case we don't read that, then later on it might even it may be a very big difficulty when you are selling the assets. Second, my experience is that when the valuers are visiting, at that particular time, the RP or any of his senior team member must visit the site along with the valuers. Uh, for the reasons, one, that the valuer is doing a complete job of physical verification, and accordingly, your people or you yourself also getting uh, uh, information. uh, the physical verification is very, very important. Then I actually advise that this physical verification visit of the valuers should be completely monitored by the RP or any senior member of the RP's team. So in case there are two reports, the insolvency professional is getting two reports in CIRP and two reports during liquidation. Both the reports must be compared, and the differences in the items should be brought to the knowledge of valuers. The difference in the quantity, the difference in value, if it is a huge difference. And see, because what we have seen normally, in case we only compare the valuation given by two valuers, which is the liquidation value, which is the sum total of all the items, then you would find maybe a lot of compensatory errors. Maybe that you would find that the land, there is a huge difference in land which is getting compensated in the SFA, or there is a huge difference in the valuation of sundry debtor which is getting compensated in the contingent assets. So within this same class of asset also there can be compensatory errors, and there within the different classes of the assets also there can be the compensatory errors. So don't look at the total of the valuations done by two valuers, two set of valuers, but look at the item wise detail of the valuation done. The other important part is the grouping of the asset should be same. It should not happen that the one valuer has grouped one particular item into the plant and machinery, and the second have valued it as a plant and as a building, or the third has, or even somebody may even value it as the inventory. So the grouping has to be very clear, and there are instances that uh, the foundation is valued as building, somebody values as the plant and machinery. There are instances where the pillars and the gantry on which the overhead cranes are installed are valued as part of the shed, and the other might have valued it as part of the overhead crane. So these differences are very, very common. So grouping of the asset has to be same by both the valuers. That must be assured. The valuation should not be based on the FAR. Rather, valuation should be based on the actual physical verification, and then it should be compared with the FAR to match the items and to find the differences of the items available and items missing. The other part is that the area of the land and building should be compared between the valuers. It should also be compared with the documents available. It should also be compared with the earlier valuation reports, because this actually will create a lot of controversy in case there is a difference in the area of land or building. And it is very important that we should not look at the final rate. We should also analyze, and we should tell our teams to analyze the land rates, which actually provides us the total area and the rate applied. Similarly, for buildings also, the total area and the rate applied must be very clearly compared between the valuers. Uh, in case there are high variations in the items, that must be brought to the valuer's knowledge, and they should be uh, confronted with the differences. For valuation of the land, the leasehold land should be separately valued, the freehold land should be separately valued, because in the case of leasehold, what we are uh, what we are valuing is the contractual rights and the remaining lease period, or the terms and conditions of the lease, and the transfer charges, transfer policy. These are very, very important conditions before valuation of leasehold lands. Similarly, building valuation is very, very important. When we value the building, it should specify whether it's an industrial shed or it's an asbestos shed, the height of the shed, whether it has got RCC pillars or it has got what kind of trusses, the whether the building is residential, industrial, commercial, or it is godown, or it is store. All this is very, very important. What is the kind of foundation, whether the land leveling was done, and whether the land leveling expenditure was there in the books of account. What is the use of the building, whether this building can be used only for specific purposes, or whether this building can be used for multiple purposes. What is the condition of the building, stable, unstable, so all these facts has to be mentioned for the valuation of building. So see, building valuation should not be simply one line valuation. It should actually give us the complete detail, so that we are able to compare the one part is very important, whether the building is constructed for a particular specific use of the industry or not. Now, suppose if a particular building is constructed for only a thermal power plant, or for a hydel power plant, now that particular building has no value in isolation. That particular building will have a value only as a project. So why should I value the building? Why should I value the plant and machinery if my water availability on that river has reduced, my generation has reduced? So the entire, like whatever it may be building, it may be land, it may be leasehold land, it may be plant and machinery. The everything is reduced because this is a business. This particular land or building cannot be used for any other purpose. So the business has to be valued in such cases, like in the case of hydel power plant, in the case of thermal power plant, in various other cases where the specific building, sugar mills, where the specific buildings are created, specific foundations are created, and those can only be used for that project. So why to value buildings separately and in land separately? Because see, even if you have 100 acres of land or 600 acres of land, the person who is giving value, he will only give value for the project, only based on the income method. So the asset valuation based, see, like in what where exactly the income method has to be used is very, very important. So where enterprise valuation is supposed to be used, like maybe as I'm telling you, the projects where the specific item of assets are there, which are only used only for those projects. So that means that the project has to be valued, the enterprise value has to be valued, not the land and building. Although it has to be valued, but ultimately the valuation should be very close to the enterprise value. Similarly, in information technology businesses, in the service providers businesses, somebody who's actually into the software businesses, somebody who's developed a app, somebody who's doing a gaming business, all this is a services. So it all has to be valued on the number of customers, number of the value of each customer in the long run, the market competition. All this has to be valued on business uh, uh, income method. Legal documents has to be seen whether there is a charge or lien. While of course it is very important that the valuer should not look at the charge or should not look at the mortgages. The valuation has to be done assuming that it is all clean sale, because it is the duty of the liquidator or the RP to manage the all these charges. So the time also should be allowed to the valuers, the limitation failed. So all these experiences that I'm sharing, this is very important, and this has to be assessed by the valuers based on the information provided. So in case the information is not provided, the valuation would be incorrect. In case the valuation is not seen properly by the RP, the valuation can be incorrect. In case the valuation has not been read by the RP, later on the RP may land into the difficulties. So these are my experiences, Ankit. I think the valuers and the insolvency professionals should use these experiences, try to uh, get the work done from the valuers, and don't leave them to their own because they are
Own
also
mercy,
facing,
own
yeah,
mercy.
say on mercy, no, because they are also facing a lot of difficulties. So collective, this is a collective effort. Similarly, the forensic audit, transactional audit is also a collective effort. In case the information would be provided to him, he would give a report which is good and usable. Otherwise it might even waste time for everyone.
So our experience is that when we follow up for information, when we approach the RP with our difficulties, with when we share that we will have no option but to say this that this document or information was not available in the valuation report. At that point in time, we do get cooperation from most RPs. But yes, if the RP office understands the importance of valuations well in advance, then the information can rather come in more quickly, or I would say in a more organized manner. And that will certainly help the valuers. And getting valuation done from valuers, uh, where someone is looking at reducing these CLDs, is also very important, primarily because we say that these are the possible repercussions in case the CLDs are not limited. So there can be legal actions which can delay the whole CIP process. The legal action can come in from an aggrieved promoter. It can come in from an aggrieved dissenting creditor. Who is the dissenting creditor might say that my the asset that is charged to me is having a much higher value than what is actually valued in the valuation report. So this kind of a problem can come out. The aggrieved operational non-secured financial creditors can have a problem where they can say that they can litigate and say that the valuation is much lower because of the lack of information, because of all these CLDs. They can challenge the valuation report and get the process stuck. It can also be an aggrieved resolution applicant who has given a successful resolution plan, and who is aggrieved because he has not found assets physically available, or some other reason where there can be prolonged litigation because of some facts recorded in the valuation report. Possible effects can be rejection of a resolution plan which could have been approved, a delay in the liquidation process due to requirement of a repeat process, or lesser realization from sale of assets due to loss of interest from market for the stressed asset. So these are repercussions which are very, very heavy on the whole process, in my opinion, and therefore it is very, very important that CLD should be minimized. Lack of information, documents should be minimized, so that the valuation reports can be more trustworthy in the whole process.
Very right, Ankit. I think you can go on to the next slides, because see this, I have shared my experiences. It is very
Maybe you
clear
can
that
add a bit on how the transaction audit reports, and maybe we have an experience to share from that also, from an earlier case that we had, and how you think that transaction audit reports, CLDs in transaction audit reports can be a problem, and what is your view on this?
no, I think some of the disclaimers are very important. When the transactional audit report says that we have not verified the information, we have relied on the information provided by the promoters or provided by the RP. They also say that the report is not usable by any other person other than RP. So in such situations that the bankers do ask the report from us, because they also have to file their CBI complaints for fraud in their case. So the reports are very clearly mentioning that this is only for the RP use and it is not for the use of the committee of creditors member. So we have got various disclaimers corrected in the past from various transactional auditors, but then in most of the cases the advocates of the respondents, while they appear in the transactional applications that we file to NCLT, they first start with the disclaimers, and they are saying that how do we trust this report, because the information is not even verified by the transactional auditor. So what exactly we are doing now is that when we take the help of a transactional auditor and finally we determine the transaction in our capacity as RP, and we determine the transaction and we form an opinion that this is a transaction covered under section 43, 45, 50 or 66. In that manner we also add our own confirmations in the application, and those confirmations are actually providing us a lot more base when we fight the applications in the NCLT. So these are very important guidelines, these are very important experiences that I am sharing with you, that in case there are disclaimers in the transaction audit report, then the RP can say that this sourced from such, and those sources were official sources, and then he can say that I have determined the transactions and I have framed my opinion that these are the transactions covered under so and so. And yes, again, I would repeat that the valuation and the transaction audit both are the collective efforts of the professional appointed and the insolvency professional. So this should not be left to the transactional auditor or should not be left to the RV. In case we make it as a collective effort, then only a better report, a usable report can be made, and that can be used in future. Uh, See, I think the other part that I have experienced is, and or rather, it was also mentioned by the Supreme Court that the different applications may be filed for different transactions. Like in case there are 43 transaction under section 43 should be separate application. Transaction under section 45 should be in a separate application. Transaction under 50 should be a separate, and under 66 should be separate. Why it is why it is said? Because one, because the look back period is separate, the documents believed in all these cases are separate, and the prayers are separate, the remedies are separate. So why to collect all these applications? Because that will only create a delay in the justice. So Supreme Court has said when the criteria of determining the transaction is different, the evidences are different, then why file combined application with 40 respondents? They will never come together. They will never the proceedings would never be completed. So this will take 3 years for an application. So in case you find a separate application which is very clearly a undervalued transaction or a preferential transaction, I would say even you can file separate transaction wise application to get a faster and clear results from NCLT, clear orders from NCLT. So we have even filed immediately after we took over as RP, some applications which are only without even the audit report, based on the evidences that we created, we filed applications. And they see like as probably I may say, nowhere in the regulation, nowhere in the code it is said that we are supposed to appoint a transactional auditor or a forensic auditor in the process. It is always said that the RP can appoint a professional in case he needs, but it is not mandatory. RP can himself look into the transactions, find them, determine them, and report them after framing an opinion. So my understanding about the transaction audit is that one, it is collective effort. Two, the transactions has to be reported separately to NCLT, and the transaction should be backed by confirmation of determination and framing an opinion. by the RP, that is very, very important. Simply based on the transaction audit report or forensic audit report, in case we are reporting any transaction, and in case we are not writing that we have determined the transaction, we have framed an opinion, that application may itself not be valid. Yes, Ankit.
Perfect. So I think our presentation is also through. I came across this case law which does talk about, which is a very recent case law in 2020, and talks about how the plaintiffs then challenged the valuation, the forensic audit report, and simply said that it does not make any sense. And the judges also agreed, and then they trashed the whole process. So I just put this in front of all to have a look. And that's it. We're through with our presentation. And any questions that are still unanswered, we can take them up. Although we are at 6:30, which was our scheduled time, we can take in a few questions if there are any unanswered questions at this point in time.
There is one question from Mr. Naresh Kumar, not a question but a statement. In PME, usually cost approach is used and other approaches are usually not feasible. Mr. Naresh, it has to be the present mandate is that you have to justify and have a proper caveat and disclaimer that why other approaches were not possible. So otherwise, you are not. It is not possible for you to just go ahead with one approach.
Perfectly correct. So that is a mandate under IVS also, and that is now a mandate under these guidelines also.
Another question from Mr. Gurmeet Singh. Useful life as per Company Act is say 15 years age, say 10 years, but on inspection it is found that the assets are in good shape and may be useful for the application for another 10 years. Question is, can we consider the total useful life as 20 years for depreciation exercise?
I think very well, Gurmeet. In my opinion, we can. What about you, Rakesh? I think it can be done. That there's no legal bar on somebody following any Companies Act or income tax depreciation charts. It should totally depend on the maintenance schedule or the maintenance that has already been done on the plant, and what is the status of the plant on the date of the valuation.
Yeah, correct.
I think nowadays the Income Tax Act says that the depreciation, or the Companies Act says that even if the plant and machinery is not used, you need to claim the depreciation, you need to charge the
In
depreciation.
income tax says that you have to claim depreciation even if you have not charged in your books of accounts. Companies Act also says that you have to follow the useful life concept of the assets, the predicted life of the assets, but it also allows the company to change the useful life of the assets
Mm.
based on their actual useful lives rather than the stipulated useful lives. And then you have to give a disclosure as to why you have made a change and what is the basis on which you have made the change. And you can change the number of years in Companies Act in a financial statement as on date. That is the law.
So there is a general comment, maybe that this particular platform that we are using is not good because they are saying that the audio and the chart are lost frequently. So this is reported by one Vibhuti Deshmukh, because we would actually request others whether they also have felt this difficulty or not. Are they okay with the use of this? Because this is not Zoom, because a lot many people, they are not interested in using Zoom. So we actually have found this Zam webinar, which is an American product. So we thought that rather than Chinese, we should use an American product. So in case it is not comfortable, then we can shift to something else. But still, I think there are. We will share the presentation to all the participants. I'm only saying that whether this particular platform is okay, because others are reporting that it was okay. So I think we should consider that this particular platform was
So
okay,
some
and it
are
was.
saying it was not okay.
Some was saying it was not okay.
And also there is a thought process in my mind that people who are having difficult technical difficulty in attending this webinar may not be there with us any longer. So I think this will anyways be a partial poll.
Yeah. So I think, Ankit, is there anything else? Because all these mostly important questions have been taken up, and our time is also up.
So thank you everyone, and thank you for listening to us. It was a pleasure on speaking on this topic, and of course we will share the video as well as the presentation by email, the way we have already done in the past. And thank you so much for listening to all of us.
Thank
Thank
you,
you.
participants. Thank you
Thank
very
you.
much. As we always say, that this is our way of learning. Thank you. We'll
Thank
connect
you.
again.
Thank
Thank you
you.
very much.